name is Jeff Foody. My company is Reverse Mortgages Northwest. We are a subsidiary of Pacific Residential Mortgage. The purpose for our class today is going to be reverse mortgages for purchase specifically. I've been doing nothing but reverse mortgages for almost 13 years now. I don't know anything about forward mortgages. I couldn't refinance your house if my life depended on it. But reverse mortgages, I know backwards, forwards, inside and out. So as we're talking today, the way this training is going to go, because this is a CE class, I want to make sure that you're getting something out of it. I don't have a PowerPoint presentation. I don't have a video to share. This is just going to be us talking. So I want to make sure that I'm giving you what it is that you want to hear from me. So the way I like to start out all of my classes is I want to know what you want to hear from me. What questions do you have? Do you want to make sure that I cover? Obviously, we're going to cover the reverse mortgages for purchase, but what sort of things do you want to make sure that I cover about reverse mortgages that you may have had questions about before? What do you want to make sure that I cover?
Timelines.
Timelines, okay. What else?
Interest rate premiums.
Rates, okay.
The process.
The process, okay.
Condominiums.
Condos. It's a very popular one at the moment, okay.
1 to 4 family properties.
Multi-units,
Multi-units.
okay. I'm going to lump those two together into eligible properties, right? Okay. What else? No question too difficult, no question too rudimentary.
Potential pitfalls.
Okay. Potential pitfalls, always a good one. What else? I have plenty of information that I can cover with you, but I just want to make sure that you guys have what you want out of this class. Now, let me tell you what I want out of this class, my objective, so we make sure that we're both clear and we're on the same page, what it is that I want. I want to be your guide, right? The reverse mortgages are vastly misunderstood, right? There are a lot of, even with clients that have been through training and through counseling, they still have the same basic questions. And so as these become more popular and you start hearing about them more, I just want to be your resource. That's my objective. That's what I want out of this. I want, oh, I heard about this. I know a guy. Let me ask him. That's what I want out of this. Okay, I don't do forward loans, so I know you're all realtors. You have relationships with forward mortgage companies that you do business with. Keep them. I'm no threat to them. They are no threat to me. This is all that I do. So, again, my objective here is over the course of the next hour is to give you the information that you want to understand how reverse mortgages work better. And then what I want is when we come out of here, you've got my contact information for any questions. You've got my emails, my phone numbers. Again, the best that I can ask for out of this is I'm your reverse mortgage guy. If you have questions, anything that comes up, there's a great deal of misconceptions, and we're going to talk about those today. Again, this is going to be interactive, so please don't hesitate to interrupt me. Don't hesitate to ask questions. I'm not really sure I understood that. Could you follow up with that? Please let this be interactive. I want to make sure that I'm covering the things that you want out of this. Okay, so any other questions that anybody else thought of? Please.
What are the real trends?
What are the real trends?
How many people are getting reverse mortgages?
Okay, how many people are getting reverse mortgages? Okay, good question, thank you. Anything else?
Is it harder to get through underwriting?
Is it harder to get through underwriting? Okay, so I'm going to talk about underwriting guidelines. Okay. Anything else? Okay. And again, as we're going through this, feel free to go ahead and stop me and suggest, there's something else that you want to make sure that I'm covering, and I'll make sure that I cover all of those questions. So, yeah, please go ahead.
I'm guessing when you get a purchase reverse mortgage, is there some kind of chart that shows the balances of increases as the years go on in the reverse mortgage?
You mean like an amortization schedule?
Yeah, I guess it would be a reverse amortization schedule.
Okay, so yeah, absolutely. There are amortization schedules, and we'll cover a little bit about how it's going to look over the process of the time that they have the loan, what it looks like. Okay. Absolutely, I'll make sure we cover that. Okay. So let's start off with, well, let me give you the basics first, okay? There's been a lot of exciting changes that have taken place. As of today, which is August 20th, 2014, it's a really exciting time for reverse mortgages. We just saw some major changes take place about 2 weeks ago. So traditionally, this program's been around since about 1989. Okay, that's when FHA came out with their reverse mortgage. The original concept was, it was kind of built like an annuity. So the idea was, back in the mid 80s, like an annuity, you would give up the value of the home, you'd give up the house, somebody would let you stay in the house for the rest of your life, and then when you passed away, the house went back to the insurance company, whoever it was that did it. That was kind of the original concept. When FHA got involved, they said, well, let's create a program that will allow seniors to stay in their home and access some of the equity in their house without having to repay it, as long as they're in the home. But they keep the house. Now, the first question, being in this for 13 years, and I've done thousands of reverse mortgages, the first question is, do I keep my house? I'm sure you've all heard the same question. That's still an enormous misconception. Yes, they keep their house. This is just a mortgage, like any other, right? Their name is still on the title to the home. So, the idea is, if a borrower is at least 62, they're able to access a percentage of equity in their home. Okay? So, from the amount of equity that they qualify for, they have to pay off any existing liens against the property. So if they have a mortgage, if they have a first, a second, back taxes, they have to pay that off out of the proceeds. The rest of it is their money to do whatever they want with. Now that new loan that they're taking out, they don't have to make mortgage payments on, they don't have to repay it. It's just a loan that defers their mortgage payments for the rest of their life. So if you want to think of it like a traditional forward mortgage, which is kind of difficult to do, but imagine a 30-year fixed loan that defers the mortgage payments for life. That's kind of how it works, right? They stop making their payments, but since they stop making their payments, their balance is increasing over time. So that's kind of the general idea of how the reverse mortgages began. When the program came out in 1989, they offered a small amount of them kind of as a pilot program. They were gobbled up quick. They started to realize that this is a need, that seniors started really wanting something like this. Every year they raised the cap on the pilot program, and every year they hit the cap. More and more people wanted them. In early 2000s, AARP got involved. And they said, okay, if this is going to be a program that is going to be geared towards seniors, we want to make sure there's consumer protections put in place. Right? So one of the things they added was there's a mandatory counseling session. They wanted to make sure that before seniors got involved in this program, that they were educated and they understood how it worked before they started the process. They've limited the fees of what they can be charged, so they can make sure that seniors aren't being gouged when taking out one of these loans. So that's when you started to see a lot more commercials on the television. You started seeing these become a lot more popular. So you started seeing Robert Wagner and James Gardner and the Fonz, right? They all started coming out around that mid-2000s till now, because the program became a lot more popular. Now, just recently, we've gone through some changes as of August 4th that have literally revolutionized the reverse mortgages. Let me give you an example. Before, both borrowers had to be 62. If one was 64 and the other spouse is 58, it's what they call the non-borrowing spouse. They would do the loan on the 64-year-old, the 58-year-old wouldn't be on the title to the house, which means in the event that they passed away, they're not on the title to the home. They'd have to refinance it or figure out something else with it. So as of August 4th, they've done away with that. Now, as long as one of the spouses is over 62, they can both do the loan. So you can have a 58-year-old, you could have an 18-year-old. It's a little weird, but I'm saying theoretically you could, and they could both be on the title to the house and do the reverse mortgage as if they were both over 62 to be able to qualify. Please, Craig.
Is the qualification based on the youngest person?
Is the qualification based on the youngest person? Yes. So the amount of money that they're able to qualify for is based on the age of the youngest borrower. The younger they are, the less money they qualify for. The older they are, the more money they qualify for. The idea being, In most cases, this is their last loan, right? And they figure they base the amount of money they qualify for on a mortality table, similar to an insurance policy. They figure if they're 62, they're going to live for 25, 20, 28 years, whatever it may be. They're going to make sure there's going to be enough equity in the home, so they're going to qualify for a smaller percentage. This is an FHA product. FHA doesn't like losing money. So they want to make sure that they don't give out too much, where for however long they have the loan, that there's a chance that it goes upside down, and FHA has to eat the difference. They want to make sure that the percentages of what they're qualifying for, the older they are, the more money they get, because they figure they're probably going to be there less time. The younger they are, the least they qualify for, because they figure they're probably going to be there longer. So if you have a 75-year-old and a 62-year-old, the calculations are going to be based off of a 62-year-old. Now, that being said, the next question probably that's going to come out, and I'll beat you to it, is, well, how much do they qualify for, right? There is no rule of thumb, right? There is no, well, if you're this age, this is the percentage. It doesn't work that way. Every single borrower, every person we talk to, we have to run in a calculator to be able to give us exactly how much they qualify for. One time I tried to figure it out, and I ran 62, 63, 64, 65 on 100,000, 125,000, 150,000, and I made this big matrix and tried to figure out the percentages. They were all over the map. There was no rhyme or reason to it. So for every instance, we have to run the date of birth for the borrowers, how much their house is worth, and then it figures out what the percentage is going to be. For a rule of thumb, I usually say at 62, they need about 50% or thereabouts, give or take, just kind of a good idea. Question?
Does their credit history come into play?
Does their credit history come into play? Thank you very much. The credit history at the moment does not come into play. At the moment. So let me clarify. As of today, again, August 20th, 2014, it's the 20th, right? Okay. We don't care about income, we don't care about credit. It doesn't make a difference. It doesn't matter. Whether their credit scores are 800s or 500s, it doesn't make a difference. I say at the moment because FHA announced that there's going to be a financial assessment tool that's going to be assessed for reverse mortgages. 10% of reverse mortgages default. And the reason that they default is because people stop paying their taxes and insurance. So if you've got a client that has their taxes and insurance paid as a part of their mortgage, and now you've paid off their mortgage and they don't have mortgage payments to make anymore, they forget that their taxes and insurance were part of their mortgage payment, and they stop paying their taxes and insurance. So what FHA is trying to do at the moment, again I say trying to do because it's not out yet, is that they're trying to create a tool where we can check their credit, we can check their income, they can check their ability to make sure they can keep up their taxes and insurance. And if they've had a history of not being able to keep up their taxes or insurance, then maybe they would set up an impound that they can cover out of the proceeds of the reverse mortgage. They'll set up an escrow account to pay the taxes and insurance. As you can see, that's a mess. How that's going to work, we don't know. You know, if a borrower didn't have insurance for the last 3 years, are they going to set up escrow for life? We don't know. So that's why they haven't come out with this program yet. They announced it back in October. Here we are in August. We still don't have it because there's still details that need to be ironed out. So as of right now, we don't care about debt, we don't care about income, we don't care about credit, but in the near future that might change. That will change in the near future. And again, that's only going to change for people that have had problems in the past keeping up their taxes and insurance. Please.
So there's no regulations on deferment of maintenance of a house, for example? I mean, it could be the house goes down in value because they defer all the maintenance.
Okay, so the question is about deferred maintenance and how does that affect it? These are an FHA loan. They have to meet FHA standards. At the time of application, they have to meet FHA minimum standards. If they've had deferred maintenance, we have to have that house fixed up and raised to FHA standards at the time of closing. And they have to maintain that property. They can default if they come back in 5 years' time and find out that the roof is caved in and they haven't done anything about it. Because again, with a traditional forward mortgage, everything is about the borrower's ability to repay the loan. right? That's why they care about credit and income. With a reverse mortgage, they don't care about that. They care about the asset. Everything's about the house, right? Does the house meet FHA guidelines? Is there enough equity in the house that they're not going to be losing money? It's all about the home. So the deferred maintenance is a great question. Thank you.
So there's a part of the program. Every 5 years, they're going to come and investigate, or is it spot?
It's unknown. The rule. So the question was, does that mean that every couple of years they're going to come out and take a look at it? The rule is, and it's written in the guidelines as a part of the closing documents, that you will maintain the property. How that's shown, we don't know. It's not like FHA has all of this, staff everywhere that can go out and check people's homes. How they do that, I don't know. But they're told that they are to maintain their homes. You have a question?
Actually, guys, the simple answer would seem to be if you don't pay your taxes, if you don't pay your insurance in a normal loan, then they force place insurance. And if you don't pay your taxes, they call the loan.
Correct. Yeah. So it's exactly right. It's no different than a traditional Ford mortgage. If you don't pay your taxes and insurance, they're going to make you pay your taxes and insurance, or you can lose your home. It's the same thing with the reverse mortgages. It's just that for a lot of these, again, for some of these older clientele that are 75, 78, 80, that had their payments taken out of their mortgage payment, bear in mind that the reverse mortgage is based on a 75-year-old widowed woman who husband passes away and she's now left with the mortgage, trying to figure out how to get by without the other income. That's the reverse mortgage concept, right? We want to allow this woman to be able to stay in her home. If her mortgage is paid off and the taxes and insurance were taken out of that equation, she has to make sure that she's keeping up her taxes and insurance. And that hasn't been taking place. So FHA is trying to figure out a way to change the program to make sure that those people are being factored into and they're being taken care of. Please.
Are there any statistics on people that get these reverse mortgages, how quickly they run through the money?
The question was, is there statistics on how quickly they run through the money with the reverse mortgage? There are. I haven't seen them in a while. FHA made a change in was it September, October, right? Where they came back and they made a change where what the reverse mortgages was a year ago was all the borrowers took all the money out up front. So there's two different, let me come back a second. So there's two different programs. There's an adjustable rate and there's a fixed rate, okay? The fixed rate requires a lump sum distribution. Whatever money you qualify for, you take out a lump sum at closing. There's no future proceeds, there's no monthly installments, you get a check. Or there's the adjustable rate program, which is a lot more flexible. You can take some out, you can leave it in a line of credit and access it down the road, you can take monthly installments. There's a lot more flexibility with the adjustable. A year ago, everybody took the fixed. Everyone took out all the money out up front, fixed rates were like 5%, and everyone loved it. Well, what FHA was finding was that if you're taking all of the proceeds up front and 5% on all of that money, they were burning through really quick, really quick. So in October, they came out and they said, we're going to change this a little bit. First of all, we're going to cut the amount of money that people qualify for by about 10%, and then we're going to limit the amount of money that people take out at closing. If you have a mortgage that you have to pay off, no problem, you can still pay it off. If you own the house free and clear, you can only access 60% of the money that's available to you at closing. So if you've got a $250,000 house, you qualify for say $100,000 for easy math, you can only take $60,000 the first year. The other $40,000 goes into a line of credit, and you can access it after 12 months. Because the problem was, back to your question, they were burning through it really quickly. So FHA is trying to create this program. It's meant to be a lifetime disbursement. They want this to be where they have access to their equity, they systematically reduce that over a period of time to be able to help them live with longevity. That's the idea. It wasn't meant to be a financial tool, let's take out all the money and go figure out what else we want to do with it, because in most cases those people are going to be out of money in 3 to 5 years and they're going to come back trying to find out something else to do. So that's why they kind of put in that 60% rule.
The money that stays, if you leave the money in the line of credit, that accrues interest, doesn't it?
Correct. So thank you very much for that. Talk about a softball question. I appreciate those because that's fantastic that we can segue into that because that's the great part of it, right? So if you qualify for $100,000 and you don't owe anything against your house, $100,000 on the adjustable rate, you have options on how to take the money. So here's $100,000. How much do you need right now? I only need about $20,000. Okay, the $20,000 is going to accrue about 3% interest. Right? The adjustable rate's about 3%, fixed rate's about 5%. So they're gonna accrue about 3% interest on whatever money they use. So that's bucket number one. The money that they take out is accruing 3% interest. Whatever money they don't use is sitting in the line of credit. While it's sitting there, the line of credit grows. It grows to probably about 4% interest. So that available line of credit increases over time. Now, that's not a bank account. It's not sitting in a bank account. The bank account's accruing interest. It's an available line of credit. And the available line of credit increases. So, here's how that works. Like I said, a 62-year-old qualifies for a certain percentage. A 63-year-old will qualify for more. A 64-year-old will qualify for more. What they're doing is every year, they're crediting you for getting older, and they're unlocking more available equity. So it works out to be about 4%.
That's a sweet deal.
It's a sweet deal. So for financial advisors who are looking at this product and saying, well, my borrowers at this moment don't necessarily need all of that money, but they might a couple years down the road, you can open the line of credit today, leave that money in the line of credit as a financial security blanket. If you need it, it's available. If you don't need it, it sits there and grows. Now, the amount that they qualify for is based on how much the house appraises for at the time of closing. If the value goes down, it doesn't affect that line of credit. The line of credit is going to continue to grow. So, had you done something like that 5 years ago, you'd be looking like a genius, right? Because the house would have tanked, but that line of credit's still going up. So, the line of credit's become a much more friendly tool. Now, in addition, another change they made in October, which made this a much more practical option, is they lowered the closing costs. Okay? There are 3 closing costs on a reverse mortgage. One is the origination fee, which is where companies like us make our money. It's federally regulated, right? It's 2% on the first $200,000, and it's 1% after that, and they cap it at $6,000. So if you've got a $400,000 house, $600,000 house, it's a $6,000 origination fee. There's a cap. You can't charge any more than that. The second fee is your third-party closing costs. Title, escrow, appraisal, notary. As good as title and escrow is, they like to get paid for their efforts. I know it's a crazy concept, but they like to get paid for the work that they do, as well as appraisers and everyone else that's a third-party part of the transaction. They've got to get paid. So there's your origination fee, your third-party fees. The third one is usually when we're explaining to our borrowers, we got to take a big gulp. Because the third one is the mortgage insurance premium. Right? This is an FHA product, so typically, before October, it was 2% of the appraised value. So if you've got a $400,000 house, it's $8,000 just for the mortgage insurance, upfront mortgage insurance premium. Regardless of how much money you take, regardless of, that doesn't matter, $8,000. In addition to your other closing costs. It was not unheard of to have $18,000, $20,000, $22,000, $24,000 in closing costs on a reverse mortgage. I've been doing this a long time. I remember those days. Like I said, it was, okay, well, let me explain the origination fee, third-party closing costs. Okay, those are a normal part of the transaction. Let me take a big gulp, and let me explain to you the upfront mortgage insurance premium, right? It was heavy. As of October, when they put in that new 60% rule, they also changed the upfront mortgage insurance premium. They said if you're taking less than 60% out up front, FHA is taking less risk. So they're not going to charge you as much. They're going to charge you 0.5%.
Wow.
Is that 60% of what you qualify for?
60% of what you qualify for, correct. So on a $250,000 house, if they're qualifying for $100,000, if they take less than 60%, it's 0.5% of the upfront mortgage insurance. It's a quarter of what it used to be. Now on the flip side, if they have a big mortgage that they're having to pay off and they have to take more than 60%, It went from 2% to 2.5%. So the upfront mortgage insurance premium increased. Now, the purpose of the mortgage insurance premium is contrary to belief. When you hear insurance, that sounds like, oh, that's a good thing. No, it's not. Not for the consumers. It's not for the consumers. It doesn't cover the consumers for anything. The upfront mortgage insurance premium is for FHA. They want to make sure that they're not going to lose any money on the loans. Okay, and here's what I mean by that. These are a non-recourse loan. Worst case scenario, if they take out a bunch of money and they live for 20, 25 years, and the interest rate accumulates, but the housing market tanks and they owe more than the house is worth, you can't pass on the debt to your heirs. Worst thing that can happen is you leave the keys on the table. Say, thank you, FHA. I appreciate you allowing me to stay in my home. The house is yours. It's upside down $200,000, but that's your part. FHA makes it so that you can't pass on the debt to your heirs. If it goes upside down in value, FHA eats the difference. That's why they have that FHA mortgage insurance premium. A couple years ago, they lost $4 billion on reverse mortgages because when the housing market tanked, they were all upside down. They passed on. There was no equity left. Heirs didn't want to deal with it, left it to FHA, and they ate about $4 billion. So that's why that upfront mortgage insurance premium is good in that you can't pass on the debt to your heirs, but it's expensive. A question back.
Yeah, how does FHA sell those properties? Do they have a realtor program or something where you get those listings?
Let me give you as best of an answer. That's a great question. Thank you. So, in the event, since I'm talking to a group of realtors, I appreciate that question, which was, well, what happens to those houses after FHA gets them? How do they sell them? So I had a client down in Grants Pass who was upside down. Their house about $200,000. This was before they had the non-borrowing spouse. So her husband was old enough, she wasn't. Her husband passed away, she was in the house, and she had to sell it. So she put it on the market, and this was 4 years ago. So this is 2010. How was the market in 2010? Right? It sat there forever. So FHA said, here's what the outstanding balance is. Here's the appraised value. We will accept 95% of the appraised value of the house in order to recover what they lost. Why 95%? Because that 5% pays for the realtors. They want to make sure that they can sell these loans and that they can sell these homes and they can recover what they can for, and the realtors get paid. See, FHA's got your back.
Was that in the fine print or something when you signed the mortgage?
Yeah, so in the note and in the deed of trust, they go through and they explain what the percentages are of how much has to be repaid, and that's included in there.
Okay.
Another question.
Well, my question was similar to hers. I was just wondering if in a foreclosure situation, do you go through a normal FHA foreclosure type of a scenario?
Yeah. Usually at that point, we're pretty much out of the picture at that point, but I've got clients that have worked through them in the past and they run through them. Yeah, it's the same thing. Now, important to know that upon their passing, because usually the first question is, am I going to lose my home? The second question is, what happens after I die, right? So the reverse mortgage is based on both borrowers. As long as one of them is living in the house, they don't ever have to make any payments. If they both vacate the property for 12 consecutive months, then the loan gets called due. All right, now I'll explain exactly why I use that terminology. In the event that a person has to go into a care facility and they're there for 12 months, statistically speaking, they're not coming back out again. That's why they have that if they vacate the property for 12 consecutive months rule. Once the loan is called due, by either they're passing, they're selling it, they're moving out of it, it's their primary residence, the house goes to the heirs. They call up the heirs and they say, okay, here's the outstanding balance. What do you want to do? The heirs have the option. Well, I'm going to try and sell it because there's still some equity there and we'd like to keep that. Or we want to refinance it. It's no different than if you have a mortgage against your house today. You pass away today and leave it to your heirs, same thing. They can refinance it and keep it. They can sell it, keep the equity. It's no different with a reverse mortgage as it is with a traditional forward. House goes to the heirs. They can choose what they want to do.
So if the heirs can't pay it off, then it goes into foreclosure, but the heirs aren't the heirs have no liability?
Correct. Heirs have no liability. It's non-recourse. Nothing gets passed on to them. Worst case that can happen is there's no equity left in the house to leave to the kids. Please.
So someone, they go through the money.
Okay.
It was said to them, you can't be taken out of your own house, right?
Yeah, you can't kick that. No. So if they spend all of the money, they're there forever.
But if they don't pay their taxes and insurance, they're out.
Correct. That's correct.
So
if they don't pay taxes and insurance, that's like it is with any mortgage. If they stop paying their taxes and insurance, they can be kicked out. If they take it out today at 62 and they spend all the money within the next year and they don't have any money left, they still don't have to make any payments if they live to be in the house until they're 92. And the house is completely upside down. There's no equity left. As long as they keep the taxes and insurance, they still have a place to live.
But if it's in the will to the children,
Uh-huh.
that they're leaving this, the children automatically inherit this problem? I mean, then the children would be responsible for that 5%.
Okay, so the question was, in the event that it passed on to the heirs and the heirs get it through the will and it gets their house, did they get this problem? Again, they're going to get just like a traditional forward mortgage. Right? They're going to get a house that's going to have a lien against it. They're going to have the option. Do they want to sell it because there's some equity there? Then sell it. If there's no equity there, again, toss the keys on the counter and walk out the door. It's not their problem. Worst thing that can possibly happen is there's no equity left in the house. If it's upside down, they cannot pass on the debt to their heirs. So it's not a problem for them.
Can they rent it?
Can you rent it?
Could the heirs rent it?
There is a provision in the note and in the deed of trust that says that any income that is derived from the home after the loan's been called due, they can collect. Because at that point, there's still an ability to repay. The terms of the loan passed with the borrower's passing, the loan is called due. If they're trying to sell it and they're taking them a year to sell it and they're renting it in that period of time, the lender has claims to the rent. Any income that's been derived from that property.
Assignment of rents, that's
correct.
Any rental property.
Correct.
Flex properties.
Okay, so let me get back here to eligible properties. So if you called and talked to 10 different reverse mortgage companies, you probably get a different answer than what I'm going to tell you. Okay, the answer is I'm going to give you FHA's guidelines. This is what we operate on, FHA's guidelines. Single family residence, HUD approved, FHA approved condos, multi-unit dwellings, so 1 to 2 to 4 family units, manufactured homes, yes. As long as they're built after June of 1978, they have a permanent foundation and they own the property underneath, we can do them. If you call 10 different mortgage companies, 9 of them will tell you they don't touch manufactured homes with reverse mortgages. You can, we do. Most of the people don't like touching them, but we can. So it's absolutely possible. Especially in Oregon, we get a lot of them here. We do them all the time. They're pretty routine. Potential pitfalls, again, worst thing that can happen is there's no equity left in the house. I was actually just met with a client just yesterday. Their son flew in from Atlanta and he was talking about they desperately wanted to leave their house to their kids. They wanted to leave it free and clear to their kids, but they didn't have 2 nickels to rub together. So they needed to access the money in their house. And the son was trying to tell them, oh, don't worry about it, take care of yourselves. And they're like, no, we want to leave this house to you. So one of the things that I would say in that situation, and again, this is not my area of expertise, but talk to a financial advisor. Learn about term insurance. Learn about a second to die life insurance policy. Learn about something that the borrowers are taking these proceeds out, they can use to pay for premiums for an insurance policy. When they pass on, the insurance policy pays for what's outstanding on the reverse mortgage, and the heirs can have their house free and clear. So potential pitfalls are ultimately the heirs are the ones who are going to be affected by it. Not the borrowers who have their home. They get to keep their house. The heirs are the ones who are going to be affected. I've had clients, and I swear one time in 13 years has this happened, but a lot of my time is spent talking to their financial advisors, to their attorneys, to their kids, and their kids, that's their inheritance, right? They've got this claim to their parents' home, and they feel like, how dare their parents give up their inheritance? And so I sit down with them and say, look, here's what your parents' mortgage payment is every month. I'm going to give them that money back. If you want the house, you can pay their mortgage every month. And then they're happy. Then they can get by, no problem. One time did the heirs actually do that. Where the kids got together, they pulled in their money, and they paid their parents' mortgage so they could keep the house.
Spend it
One
to
time.
zero.
One time. But they've got this, that's their inheritance. Again, so potential pitfalls, worst thing that can happen is no equity will lead to their homes. Please.
Jeff, what is the definition of primary residence?
What is the definition of primary residence? Primary residence.
Well,
No, I understand what you're saying.
Right.
Right.
So use myself as an example. Our son and daughter and our new granddaughter live in San Jose, California. So if we wanted to buy something down there,
Yeah.
we would have, and if we wanted to use a purchase reverse mortgage, how would we prove that that's our primary residence?
Okay, so how are you going to prove your primary residence? It's a good question. Where do you pay your taxes? What's your driver's license say? Where are your bills? I mean, it wouldn't be any different than qualifying for a traditional mortgage. How you're proving your primary residence, same guidelines. It has to be legitimately where you live most of the time. What's your driver's license say? What do you pay your taxes? That sort of stuff. At the moment, again, August 20th, 2014, you can only do a reverse mortgage on your primary residence. There are rumors, there's always rumors, of a proprietary reverse mortgage that you can do on investment properties, that you can do on non-FHA approved condos, that you can do on jumbo loan amounts, where they're going to be, $2 to $3 million homes. I failed to mention, since this is an FHA product, it is based on FHA county lending limits. Right now, FHA county lending limits for reverse mortgages nationally is $625,500. So, regardless of where you are in the country, I remember a few years ago, we were abided by whatever the county FHA county lending limits were. As of right now, it's $625,500. So, what that means is, if your house is worth $1 million, they're going to look at it like it's worth $625,500. From that, you would qualify for whatever percentage you qualified for of the $625,000. So this jumbo idea sounds great in California, where their home values are $625,000. They kind of laugh at that. They're like, where can you find a house for that amount? In some areas, mind you, San Jose being one of them. Underwriting guidelines. This is my favorite part about reverse mortgages, is they're really easy. I don't understand how people can do traditional forward mortgages. I don't get it. You got to prove your income, you got to prove your debt, you got to prove this, you got to prove that, you got to make a round peg, swim in a fair hole. I don't get it. The reverse mortgages, man, my life is so simple and easy. They're over 62, it's their primary residence. They, however much they qualify for, can pay off what they owe. Done deal. Underwriting guidelines, really easy. Please.
Okay, say you got a husband and wife, and the wife has never worked, and she's the youngest. So how do they?
I don't care. So the question was.
But you said they qualify on the younger of the two. She's never made any money.
Doesn't matter.
Just the age.
Again, so the question was if you've got a husband and a wife, and the wife is under 62 and she's never worked and she hasn't had any income, we don't care about income. We don't care about credit. We don't. It doesn't make a difference at all for the reverse mortgage. As long as they're over 60, well, as long as one of them is over 62, they're going to base it off of the age of the 62-year-old, and they're going to qualify. It doesn't matter their income, doesn't matter we're not going to ask for WTs.
The age of the 60.
The age is what matters, that's correct.
Okay.
The age is what matters. It has nothing to do with the income. So, again, we're going to come back to this in a second. The purpose of the class, reverse mortgages for purchase, how nice is that? We don't care about their income. We don't care about their credit. They can still qualify. Question?
Oh, I'm sorry.
If you have a reverse mortgage, could you still rent out a room in your house?
Yes. So the question is, if you have a reverse mortgage, can you rent out a room? Yes, you can. And also, if you have a reverse mortgage, you can do what they call a streamlined refinance and pull out from a reverse mortgage into another reverse mortgage. So let's assume the housing market gets better and you've used all of the proceeds and the house goes up in $20,000, $30,000, $40,000 in value, you can do what they call a streamlined refinance, where your closing costs are a whole lot cheaper, get a new appraisal done, qualify for more, pull more money out of that house. Yeah, absolutely. You got another question, please?
Well, you've mentioned several times that the older the person is, the more they can borrow. I just don't get that at all. If you've got 5 years left to live, why would I want to give you more money than your spouse that has 20 years left to live?
Because, well,
They want your money.
two different questions. So there's two different answers to that. Because one, you said if they're 90-something and their spouse is younger, it's going to be based off the age of the spouse, right?
The younger.
The younger of the two borrowers. If you have an individual who's 95, they're going to qualify for a higher percentage than their neighbor across the street in the same home who is 62, because they're going to have a shorter life expectancy, which gives them a higher percentage of their equity. The younger they are, the longer they're going to be there, which means the more risk FHA is taking in the amount of money that they're qualifying for, and there's more time that the house could go upside down in value.
Okay.
That's why the younger they are, the less they qualify for.
In my mind, I keep thinking that over time, you're going to have your recessions, but you're going to have an increase in value typically.
We would all love if that were the case.
Well, it is
right
the
now.
case.
I'm saying right now. You know what I mean? So what you said was, assuming that over time that it's going to increase in value. Right now, we're all hoping for that day. It's looking a little better. We like it. So the reverse mortgage guidelines are simpler and easier. We talked a little bit about the credit. The process. Now, the process is different on reverse mortgages. And again, I promise we will get to the bread and butter, which is the reverse mortgages for purchase. The process is simple. The first step is education. And the second step is more education. Right? We want to make sure that they understand what they're doing. We send them a proposal, we talk to them over the phone, we explain everything to them, we give them paperwork, they can see it all in black and white. The next step after that is they talk to a neutral third-party counselor. Someone that's approved by HUD, approved by AARP, and they explain to them how the reverse mortgage works. We do that before taking an application. Because once they sign their name on a piece of paper, they feel like they've obligated to something. Even though you can tear it up the next day, they feel like they've obligated to something. Now, not all reverse mortgages companies work that way. We do. We say counseling first. Once I have a certificate in my hand that says a neutral third party says you understand how this works, then we take an application. Then we order an appraisal. Okay? And the reason for that is pretty simple. 4 times in my career, I've had heirs come back after the fact and say, you took advantage of my parents. They didn't know what they were doing. No one explained this to them. They were confused. And I came back to them in all 4 of those circumstances and said, here's the application, here's the date, here's the counseling certificate, here's the date. They were counseled first. A neutral third party said they knew what they were doing and they understood it. And they were explained by them, they understood it, and then we took the application. That's why we asked that. That's why we do it that way. We want to make sure no one feels like they're taken advantage of, that they understand what they're doing, that they understand how the program works. So the process is a little bit different. With a traditional forward, someone says, I'm interested, you get a 1003, right? Is that what they're called? Just want to make sure. Right? They get a 1003, they pull credit, they see what they qualify for. Not that way with the reverse. If they're interested, okay, we send them a proposal, we explain it to them, we get them counseling, then we take an application, then we order the appraisal, FHA appraisal. Process usually takes, realistically, 30 to 45 days. We can get them done faster than that. It depends on the circumstances. I tell my clients, if you expect about 45 to 60 days, you shouldn't be disappointed. That's from, I know Matt's smirking over here, I don't have to look at him, 45 to 60 days is assuming they've got counseling done and done an application. It takes 45 to 60 days. Some of these clients, like the first time we talk to them, it can be months or years before we actually complete the transaction. We take their time. Whenever they feel comfortable with it. We've got clients we just spoke about yesterday that we originally talked with them and sent them a proposal 3 years ago. And now they're coming back and saying, okay, I'd like to do this. That's part of the process.
Do they have to go back through counseling again?
Well, we wouldn't have gone to counseling, but yes, they would. Counseling certificates are only good for 4 months, so we've got to get those in. Okay, so we want to get to we've covered most of these questions here. In the proposal documents that we give them, there's an amortization schedule. Every month, they're going to get a monthly statement, just like any other mortgage. Here's how much you owe. If there's a line of credit, here's how much money is available. Every month they're getting a monthly statement, just like a normal mortgage. Tell them how much they owe, tell them how much is available. It's pretty simple. Yeah,
If you decide you want to pay a few months out of it, you can do that?
Yeah, this client that I met with yesterday, when his son came up, they were concerned about, again, leaving them in the house. I told them, look at like a refinance. Okay? Right now, they were at a ridiculous 10% interest rate on a $30,000 mortgage. It's ridiculous. And so I said, well, look at it this way. We'll do the adjustable. We'll give you 3% interest rate. We'll leave a big line of credit available if you need more money. But just look at it like a refi. Make a mortgage payment every month if you want to. And pay that down, that $30,000 balance, if you want to leave the house to your kids. And if Christmas comes up, you want to save a little bit to buy something for your grandkids, skip a couple months of mortgage payments. You can't do that with your forward. You'd be on your keister. But with the reverse, you have the flexibility. Pay $500 one month, $1,000 next month, nothing for 6 months. It's flexible. They can make payments on that. And for CPAs, they like that. CPAs hate reverse mortgages. They hate them. Because their job is limiting your tax liability. If you pay off their mortgage and they're not making mortgage payments anymore, they lose that interest right off on their taxes. But if they make payments, the interest that accumulates, they're making payments on that, they can still write that off on their taxes. So, process is a little bit different. Rates, again, it fluctuates. Adjustable rate is tied to the LIBOR index. It's pretty stable, hasn't really changed much in the last couple of years. So the adjustable rate's about 3%, the fixed rate's about 5%. Now, let me get to, now that we've been here for a little while, the reverse mortgage for purchase. Okay, forget everything I just told you. Okay, because everything we've just talked about is a refinance, right? Now, the reverse mortgage for purchase works backwards. Okay, there's two things I want you to remember. Two key phrases. A reverse mortgage for purchase either allows you to buy twice as much home or spend half as much money. Buy twice as much home or spend half as much money. And let me give you two examples. On the piece of paper that we've got handed out, you guys can look through, there's a little flow chart, right? If you have a borrower that has a 300, so I've got a client right now who just inherited a home. And when it's gone through probate, they're selling the house. Her part of it is she's getting about $140,000. Okay? She wants a house in Jansen Beach. Can anybody here sell a house for $140,000 in Jansen Beach? Not likely, right? So we found for her a condo in Jansen Beach for $315,000. She took her $140,000 and used it as the down payment. The reverse mortgage makes up the difference. So it sees a $315,000 house. She's qualifying for a reverse mortgage for about $170,000. She bought the equity for $140,000. So she comes in with her cash, puts $140,000 on the table. The reverse mortgage makes up the rest. She buys a $315,000 house and has no mortgage payments.
Does she still have to be 62 years old?
She's got to be at least 62 years old. Yep. So again, you can buy twice as much house. Whatever money they have to put down, the reverse mortgage can make up the rest of the financing. And they can literally buy twice as much house, sometimes more, with using the same amount of money. So, from a realtor's perspective, you may have clients who come in, they're over 62 and they have cash. They just sold another house, they've got money to put down, and they want to buy more of a house. You can't find them what they're looking for. Right? I had a client who came in, they had $225,000. This was going to be their last house. Right? They wanted all of this stuff, they wanted a $10,000 Viking range stove, they wanted all these different things, and the realtors just spent months trying to find something, couldn't find anything. So they came to me and said, well, what can we do? This was December of last year. I said, let's custom build them a home. Let's get with a builder, let's custom build a home that they want, the way that they want it. The end result was the price tag was about $620,000. They put down $240,000. They were in their 80s. The reverse mortgage paid up the rest. They got the house that they wanted. They've got 0 mortgage payments, and I'm that realtor's new best friend. Please.
Okay, so in that case, the remainder of the mortgage money, instead of going back to the buyer, goes to the seller then.
Say again?
Well, in other words, the $600,000 house, you're loaning, or you're...
400,000.
Yeah, the 400,000 part, that goes to the seller then, instead of having to be paid back to FHA.
No. So they're buying the house for they're getting a check for $620,000. That's the seller's money, right? $620,000 for the house. The parents now get the house, and they've got $240,000 of equity in it.
Okay.
Because they used their proceeds to buy $240,000 worth of equity.
Okay, but
So
they don't get any other cash, right?
They don't get any other cash. They're using 100% of the proceeds
Right.
to buy that house. So, 1, they can buy twice as much, or 2, spend half as much money. So I have another client out in Bend that we're waiting September will close. They had this two-floor home in Bend. They didn't like getting up and down the stairs. The home had fallen into disrepair. They just couldn't keep it up anymore. They sold the property and they pulled out $200,000 in cash. And they said, "This is all we've got. This is all the money we have left. We don't want to buy another house for $200,000 and not have anything left. We're going to run the same problem that we had now." The house fell into disrepair because they couldn't afford to keep it up anymore. So I said, well, let's do this. Let's buy you a brand new manufactured home, double wide, built however specs you want, on a piece of land that you want. You don't have to do anything to fix up because it's going to be brand new. They put down $75,000. The reverse mortgage paid up the rest. It was $200,000. They put $125,000 in the bank because they only had to spend half as much money to get the home. So they could put $125,000 in the bank. They got a brand new home. They didn't have to do anything to keep it up anymore because it was brand new. And they got to put $125,000 in the bank to take care of the rest of their needs. So again, the reverse mortgage for purchase, buy twice as much home or spend half as much money. Now, the older they are, the more they'll qualify for. When I say half as much money, I'm usually thinking about a 62-year-old, so as young as they can be.
But
So
there's
they
still
can.
a debt to income.
What's that?
There still must be a debt to income. You've got
No.
high property taxes on
There's
that.
nothing to do with
$600,000 house, you're gonna have high property taxes.
I love that you
Don't you
answered
have
that
to
question.
evaluate their ability to pay those taxes?
There is no ability to pay with a reverse mortgage. This is not a forward loan. They don't care about income, don't care about credit. The only reason that we pull a credit
But they
report,
have to pay the taxes.
they have to pay the taxes,
But
correct.
what if they don't qualify to pay the taxes?
There's no qualification.
Yeah, that's a
Maybe
little risky.
maybe the better word is
Well, it's only risky for the lender. I mean, it's not
Yeah,
risky for the
really.
borrower.
They have a
Property
property, they
taken
have the
out.
home
Risky.
is the.
So again, but from a realtor's perspective, how nice and easy would it be? You have a 62-year-old client that has cash that automatically qualifies.
Now, I sold a $240,000 townhouse to a woman that was over 65, who had never bought a home in her life. She had $90,000 cash, and that's all it took. She's in her first home she's ever owned.
On a reverse purchase.
On a reverse purchase. And there's no way she would have been able to buy anything. And only because I knew about reverse mortgages, because I have a dear friend who has one, that I was able to talk, because other realtors had said, oh, you don't have enough money, you can't.
Yep.
And I said to her, yeah, actually you can. And this is how you can do it.
We can fix this problem.
That's exactly right.
And it is, it's a sweet deal.
Yep.
And she got behind on her taxes because she wasn't paying attention. And they got a hold of her, because there is someone who monitors, and they said, if you cannot pay, we will work with you. I mean, they don't just instantly kick you out. They actually were going to set her up on a program where she was going to have a monthly escrow account, blah, 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 blah. So, I mean, they don't just come in and say, out, they actually try and mitigate, so.
Yep.
Well, they want to keep someone in the home.
Yeah, they want them to stay in their home. Again, this is a, so we mentioned before about the rule with the under 62-year-olds and non-borrowing spouses. There's been a lot of press lately about heirs or spouses that weren't on the title to the house, that now their spouse has passed and they're getting this house and they're not on the title to the house anymore. Makes for terrible, terrible press. That's why FHA came out with the new rule that says if you're married, even if they're under 62, they can still do the reverse mortgage because they want them to stay in the homes. Wells Fargo and Bank of America got out of reverse mortgages because they were the ones who were servicing their own loans. they're the ones who had to foreclose on these people when they stopped paying their taxes and insurance. They got out of reverse mortgages because they couldn't handle the press. They didn't want to have to do that anymore. Nobody wants to have to do that. This is, and here's my catchphrase. When I'm explaining these to the reverse mortgages to clients, I say, forget everything you know about a traditional forward mortgage. It doesn't apply here. This is a government-sponsored benefits program. It's the easiest way to explain it. That's really what it is. It's a government-sponsored benefits program. It's a way for people to be able to access their own equity in their home, not have to make mortgage payments, and live there for the rest of their lives. From a realtor's perspective, you guys now have an option that you can buy twice as much home or spend half as much money.
Well,
It makes you look like heroes.
I mean, the other problem with people in their senior years is, I mean, if they retire and quit working, their ability to qualify for a forward mortgage is
Agreed.
compromised. You don't have the income.
Agreed,
you might
yeah.
have
That's
when
exactly
you're
right.
working here.
With the way the forward mortgage world works now, trying to get them to do traditional financing and qualify for things is ridiculously hard. The vast majority of my business at the moment are referrals that I get. I get referrals from credit unions, from banks, from other people that come and say, we can't qualify them for a normal mortgage. I smile. Yeah, I don't have that problem. Please.
How about it, regardless of the amount of the house, the owner owes 75% of the value, and they qualify for like 65%.
Happens all the
By
time.
age, does that what happens there?
So the question was, if they owe maybe 75%, but they only qualify for about 65% of the value of the house, what happens? There's two options. One is the amount of money they're qualifying for is based on their age and based on the appraised value of the house. If they don't qualify today, a year from now, they'll be a year older. They'll have made a year's worth of mortgage payments, and hopefully the house will have gone up in value. They may qualify in a year if they don't qualify now. However, they can prepay their mortgage. If they want to come out of pocket and pay down that 10%, they can do that, and then the reverse mortgage pays off the rest. I've had a lot of clients that will take money out of their IRAs or their whatever investment accounts they have, and they'll pay down their mortgage balance, the difference, so the reverse mortgage can pay off the rest. And then we have to sit down with them and we have to explain, here's how much mortgage payment you're saving. You're saving $1,700 a month. You're roughly going to save about $20,000 a year. If we save you $20,000 a year and you have to pay down your balance by 30 grand, you're going to have to stay in the house for about 18 months. Planning to stay in the house for 18 months? Okay, maybe it makes sense to pay down your balance, but it all depends. It's, again, case-by-case scenario, but they can pay off the existing balance or pay down their balance to qualify to pay off the rest. That's a great question. Thank you. Please.
Also, the closing costs, the mortgage insurance, all of those come.
Yeah, thank you.
Top.
All of the closing costs are factored into the loan. When I say that a 62-year-old on a $300,000 house is going to qualify for about 150 grand, they really qualified for about 162. They just decreased the amount available to pay for all the closing costs. So the only out-of-pocket expense to a client, and this will vary lender by lender, is typically the appraisal. Appraisers want to make sure they get paid. If they have it invoiced into the loan and the value doesn't come in high enough, that appraiser is going to be mad if they don't get paid. So most of them will have to pay for the appraisal up front. The counseling, there is a cost for counseling. It's usually about $100 depending on the counseling agency. Some of them, a lot of them, will allow them to invoice it and pay it out of the proceeds of the loan, because a lot of seniors don't have the money to come up with $100. But again, that also varies depending on the different counseling agencies. Also, one of the things that we work with is if there's repairs that need to be done, that have to be done before the loan can close because they're health or safety hazards, we have contractors that we work with that will do the work and allow it to be invoiced, and we can pay out of the proceeds of the loan. So the borrowers don't have to come out of pocket for it. So I mean, the idea is this may be the last loan they ever do, and if that's going to be the case, we're going to make sure they're going to be able to qualify to do it. Now, with the new changes that have taken place, reverse mortgages have typically been a loan of last resort. That's the way people view them. Oh, I don't have to get one of those just yet. Now, with all these new changes, it's become a financial tool because it's something now that you guys can use to be able to help borrowers buy more or pay less. So, is there any other questions, anything else that I can answer for before we wrap it up? Please.
And my question about condominiums is that there are a lot of condominiums that do not have FHA approval.
Yeah.
And FHA is now going to dictate the guidelines for how homeowner associations are handling this.
Yes.
I mean, I know of many associations, for example, that don't allow any rentals.
Yeah.
And if they don't allow any rentals, they can't get approval.
Correct. FHA approvals right now are ridiculous for condominiums. I'd say right now they're probably the bane of our existence.
Right.
We've probably got 20 clients that would qualify today if their condos met FHA approval, and they don't.
Right, and
So-
but they require a change in the bylaws, and changing bylaws is not an easy thing to do.
Yeah, that's why you'll see if you go to, every time I have a borrower that's asking me about a condo, there's an FHA, there's a HUD website for FHA approved condos. You look on there, 3/4 of them have expired
Right.
because they just don't, they've got it made it really tough. But, you know, as long as the house is FHA approved, we can make them work.
A borrow,
Please.
is required to build in the closing cost of the loan?
Not required to. No, they can pay them out if they want to. Typically, that's usually been the case.
Yeah.
So, well, thank you all very much. I appreciate your time. One more quick question, real quick.
Yeah, do you have to stay in the house until you expire, or can you sell it?
You can sell it. Yeah, it's the title's in your name. They can do whatever they want. They can
You
sell it.
just have to
pass
pay
it
off
on.
whatever the residual mortgage is.
That's exactly
Okay.
right. Thank you. Well, thank you very much for your time. We appreciate it.